we're going to have a bit of fun today. We're going to talk about 4 cases, 2 of which I've actively been involved in, and 2 of which I've studied because of how interesting they are. So the cases that we're going to talk about today are Karen. She is a fraudulent claims manager. We're going to be talking about Cedric, which is a procurement fraud. We're going to talk about the Ontario Green Energy. And finally, we're going to have a short chat about Wirecard, the global scandal that was unmasked. So let's first start off with Karen. She was a young female who had got into a position as an account manager within an insurance company. She decided that she needed a bit more money. So what she did is she fabricated an email from her casino client to her. So she learned how to type in her email address and his email address, change it, and send herself an email and stated that please change our bank account details. In the email, it had that, and to that, she got one of their templates of their letterhead. And she typed out basically the same message saying, please change it to this. And what tickled my fancy in that one was that she, at the bottom, put not signed because sent electronically. So she didn't bother forging the signature. She just said that it wasn't signed because it had been sent electronically. With this, she went down to the accounting department. No doubt she flashed her, but she made eyes at the poor guy who was sitting as the controller and said, look, we need to change this. And he did he did on the basis of the piece of paper and the email that had been sent. And they did no further verification. Once she'd got the accounts changed, what she did is she started doing small claims. So she was permitted to sign off any claim which was less than $10,000. So what she did is she started with a bunch of small claims from about $9,000 each. And she went through and she authorized the claim to be paid, and nobody was any the wiser. At the end of the year, her boss decided to take the casino manager out for lunch, and he picked up the file and went through it and saw all of these small claims going through, thought nothing of it, went to lunch and said, hey, Joe, I see that you've had a bit of a bad time this year. Saw 5 or 6 small claims going through. And Joe said, huh? What are you talking about? We haven't made any claims. So what then happened is they came back and they went into the file again and noticed that all of these claims were there. And so they appointed us to see if we could figure out what had gone on. Well, we went and we imaged her computer and we quite quickly found the email that she'd sent to herself, along with the documentation that she'd used to dummy up the letter on their letterhead. And we found all of her workings on submitting the claims. So we've got all of the documentation that was there that was needed. We had the money going into her bank account because when she changed the bank account details for the casino, she wasn't the sharpest tool in the shed and changed the banking account details to a normal bank account. So we could prove that it had gone into her bank account. Well, it was about $74,000 that had gone in. And we were all ready to go to court and lock this person up, report it to the police, go to court, and away we'd go. And at that point, we were told, no, here's your check. Thanks very much for the great work that you've done. We'll take it from here. We were quite surprised with this for obvious reasons. And we went away. And about 6 months later, it emerged. We met up with somebody who knew about the case, and he explained to us what had happened. Well, Corin had slept with her boss, and she'd slept with her boss's boss.
Your client?
Yeah. and they were both married men. And so what had happened is that she'd gone and told them, right, fine, guys, you can lock me up. You've got me. But if you do, I'm going to tell your wives what you've done, what we've been doing. And they decided that it was probably cheaper not to go down that route and not face divorce and everything that would have come with it. And they decided to let her go. So at the end of the day, she agreed to resign in exchange for her silence. And it was a textbook case in understanding leverage and insurance. Such an easy fraud to commit.
So can I ask a question, Dave? Did you wonder about when the taxman have all this money coming into your account? Not then?
No, not at all. I mean, it's unusual for the receiver to find extra money going into your account unless they're specifically looking at you. They don't track everybody's bank account 100% of the time to see whether they've received any money. So they'll only, if they thought, hang on a second, we're going to do an audit of Corin, then they would have had a look at her bank account details, and then they would have said, oh, what are all of these funny amounts going into your bank account? So that's kind of how this fraud worked. Really simple, as most frauds are, but brilliant in execution. And she certainly understood insurance. She understood that she needed to have these guys under control so that if it's ever caught, she would end up getting away with it.
The moral of the story is don't ever let your boss do any Christmas parties.
That's right. And there are some key takeaways from Corin. The first is there was no secondary verification of when the banking account information was changed with the EFT transactions. What you see on the accounts is not necessarily who you're banking under. And so it's necessary whenever somebody changes an account to pick up the phone through to their accounting department, to somebody you know there, and say, have you changed the banking details? Don't accept a piece of paper because any piece of paper can be a fraudulent piece of paper. There was another problem that she had a lot of claims under the $10,000 mark. It should have been picked up that, after the second or third claim had gone through, that this client was claiming a lot and it should have been escalated and those claims should have been independently reviewed. That never happened. And finally, there was an ethics violation, the conflicts of interest and the personal leverage that she managed to obtain by sleeping with her bosses is obviously not a good thing for anybody, for any business.
No, I mean, if we've heard anything this week, especially at the Coldplay concert, that's canoe.
And the Coldplay concert is actually quite an interesting one because if they'd done nothing, the camera would have just panned past them. It was because when they saw themselves on the big screen, they both ducked that it became an issue. They actually drew attention to themselves.
Hindsight was 2020. Like good old Cedric.
So let's move on to case number 2, Cedric. He is a procurement manager with a major transport firm. His budget was 100 million per year. So reasonable amount of money that he had to spend. He went down to a conference in the United States and he met up with Kim. Now, Kim was an attractive 20-year-old. He was a 43-year-old at the time. And she said to him, look, if you start buying some product from me, I'll make you happy. So he looked at this and said, well, now I've got $100 million budget. I can put $100,000 with this girl and I'll be, if she's a pretty girl, I mean, hey, let's see where things go. So he went and he started a deal with her where he would exchange product with her. And this was the start of the major problem. And he then ended up buying the 100,000. She ended up going to bed with him, and everything was good. About a year later, Kim moved from one company to another. So Cedric, being the good alpha male that he was, wanted to continue getting his fringe benefits from Kim because she's a pretty girl. And so he started purchasing from her at her new company. Well, the old company went, what's happening here? Here's our best customer. So they phoned up Cedric and they said to him, listen, mate, why have you stopped buying from us? I mean, hell, what can we do to get your business back? And he kind of explained to them that, the reason he'd been buying them was this pretty young sales lady who had now moved on. And they said, well, look, there's nobody else in the organization who's going to give you that type of fringe benefit. But what we can do is give you some money so that you can go out and buy that. And they decided that they would offer him around about 10% of what the amount was that he put with them. So he started buying out, pushed his orders back to 100,000 to them, and he started to receive $10,000 a month into his bank account. So, really nice, simple deal. But this is where things get complicated because the rumor mill is rife in any industry. And quite quickly, it was worked out that Cedric could be corrupted. And so a bunch of other companies approached Cedric and said, hey, listen, we can give you the same deal as this first company. And he said, okay, fine, well, I'll stop buying from you. And what happened over time is that 22 companies were paying him bribes in order to get business from them. At one point, the system had got so big that he had to involve more people within his department. So he went out and he got hold of his subordinate. We think that he might have got hold of his boss as well, and a couple of the other people working for him. But the main point of contact was his direct subordinate. And she said to him, but why are we buying all this stuff from these companies? We can make a lot more money if we set up companies and buy directly from our own companies, which they did. They started off with 2 companies, and quite quickly they worked up to $1 million a year that they were buying from these companies. And they were making around about a 300% gross margin on it. So you can see that there's a lot of money that they were making in profit. But when it got up to $1 million, Cedric started panicking a bit because he then thought, well, gee, my bosses are going to want to have a look, going to meet this new supplier that we've got that's supplying us with so much of our business. And it will look kind of funny if I walk in there in a suit and tie and say, hi, I'm the boss of this company. I'm also your procurement manager. So to stop the bosses from getting suspicious of what was going on, what happened is he turned around and he said, okay, fine, I'll just open up another company. So the one company sold $1 million, the next company sold $1 million, then the new company came on and it started selling $1 million to them. Then another company came on and another company came on. And by the time we caught up with them, there were 5 companies that were involved. Now, you would think that something like this would be found quite easy. This case went on for around about 15 years. One of the interesting parts of the case was that Kim got married in the meantime. However, the affair continued throughout. So it just goes to show what happens. And it was actually a whistleblower report that triggered the investigation. And the whistleblower report wasn't even a good whistleblower report. It just said, why are we buying stock in this manner? And that was all it said. And so when we investigated, we found out that there was absolutely no business case for the way that they were purchasing the stock. And we quite quickly found out through emails and from his computer that he was actually the person behind 5 of the companies. We also saw a lot of the negotiations with other companies where he was saying that we had to pay him a bonus. And so we had all of that very well and truly set up. The company never reported this to the police because they didn't want the adverse publicity. They did report it to their insurance company, who started off offering them 0 and eventually worked up to paying them $7.5 million. And the insurance company also didn't go after the Cedric or his accomplices. So they basically walked off free, and I believe they're now living in Dubai with their ill-found wealth and doing very well for themselves.
So that quick question: did he actually sell product from these companies, or just...
He was, so he'd go out and buy secondhand product on the market, an engine, he'd buy transmission gear, whatever it happened to be. And so let's say he found a engine for let's say $50,000, because I mean these were big machines that were being used. He would then turn around and sell it to the company for 150 or 200,000. So simply brought in the amount at a low, bought it in at a low value, sold it onto his company at a much higher value, and made a fortune in doing so. Which is really, quite scary that goes on.
Crazy. So, do you have any other theories of why they let it get away again? I mean, as a forensic accountant, aren't there more red flags there?
Well, I mean, the red flags were there all along. That both of them had bought big houses in expensive neighborhoods, which they really couldn't afford on their salaries. So any lifestyle audit would have said, there's something wrong here. I mean, he was a procurement manager and he was buying a house worth $10 million. You shouldn't be able to afford that type of investment on the salary that he was earning. But there are key takeaways here. The first red flag was that vendors were being brought on with no business rationale. The actual way that they were doing business had no rationale behind it. There were a bunch of shell companies that were set up to manipulate how the profits were earned. And then there was a complete ethical collapse within the organization. Bribery, sex for contracts, and international hiding of funds. One of the sad parts about this particular company was that they turned around, their policy said that any whistleblower who comes forward and there's a saving made from their whistleblowing report will be paid 10%. And the amount that was stolen in this particular instance was around about the $20 million mark, and they paid him about $10,000. So, if you have that sort of ethical at the top of the organization, what do you expect from your people below in the organization?
Exactly. Makes me think there's more story there.
The next one we're getting onto is Ontario Green Energy. Now, this was a really interesting story. The government put in large subsidies for wind and solar installation. Ontario wanted to move away from fossil fuels and generating their power. So we shut down all of our coal power stations. It was a great thing because since we've done that, we've had no smog days in Toronto. In fact, people have forgotten what smog days are because the air is that much cleaner. But at the time that this was done, it generated a $6 billion loss from in profit in Ontario. So just giving a short accounting lesson, if you have assets and you have expenses, they're on the same side as of the balance sheet. They're both debit entries. So if I were to move something from an expense to an asset, all I have to do is a single journal entry which says credit the expense or reduce the expense and increase the asset. And I can then move an amount out of my expenses and put it into my assets. This was signed off by 3 of the 4 big accounting firms. So we're talking Deloitte, PwC, EY, and KPMG. 3 out of the 4 of them signed off on this. It was pushed to a receivable to be paid back by Ontarians from 2022 to 2042. And Bonnie Lusk, who was the Auditor General at the time, said this is a bogus accounting scheme. I actually talked to Bonnie about it and said, why did you not call it financial statement fraud, which is what it was? And she said, Dave, we've got to be very careful about the use of the F word. So instead of coming out and saying that this is what it actually was, it was fraud, she put it down to a bogus accounting scheme, basically the same thing. The scary part is that this was signed off by 3 of the big 4 accounting firms, and it actually is an example of financial statement fraud 101. It was interesting that when the Conservatives took over from the Liberals, that one of the first bills they put in was to reverse this entry that had been made and to correct the books. And it was done for reasons. Doug Ford didn't want to show a large amount of an asset on his books, showing him a loss every year where he could attribute it to the Liberals. So there's a lot of politics in play there. But that is what occurred. A really, really basic way of moving money from expenses to income. They did make it more convoluted in getting there. They passed it through a bunch of other transactions and other entries in order to try and legitimize it a little bit more. But distilled down, it was basically a single line journal entry, moved from expenses into income and asset. So what are the key takeaways that we have there? Well, financial engineering, expense reclassification to avoid deficit. Now, we'd like to think that this never happens, but this happens all the time in businesses. We're going to miss our analyst expectations by 10 million this year. You know what? Let's just put 10 million into sales, make up the profit. Next year, we'll take it back out. When we do better, we'll take it back out again. And a lot of times that happens. We put through an entry this year. Next year, we make more money than what we anticipated, and therefore we're able to reverse the transaction. And nobody ever knows about it. The time it is caught is when the next year we don't make enough money, and that's going to be the next one that we talk about. There was an audit failure and that the big 4 signed off on questionable accounting. These are the people who are meant to be the gatekeepers for the general public. They're the ones who meant to say, no, guys, you can't do this. This is wrong. And yet, away they went and they signed off on this. And this could have had a long-term impact on being a generational burden on taxpayers in Ontario. So when you look at all of that and you put it all together, it really shows how financial statement fraud can affect not just you, but your children as well.
Do you think that another way they use is creative accounting?
Creative accounting, yes.
Creative accounting.
And then our final case that we're going to deal with today is the Wirecard case. Wirecard was the darling of the German fintech industry. It started off in a really shady space, though. So Wirecard started by banking the unbankable. So at the time when Wirecard started, nobody would touch porn websites, nobody would touch gambling websites. And so this is where Wirecard started. They started doing the banking for the unbankable. So if you ran a porn website, you couldn't use Visa or Master or Moneris or anybody like that to do your payment processing because they wanted no part of it. So you turned around and said, okay, well, Wirecard will process it. They grew from fairly humble beginnings in around about 2003. And in 2008, there was talk of a fraud within Wirecard. Well, Ernst & Young was hired to find the fraud, and they issued a clean opinion on their financial statements. A year later, Ernst & Young became the official auditor of Wirecard. So it makes you wonder what had actually happened in that investigation. Over the next 15 years, revenue surged, primarily in Dubai, Singapore, and Malaysia. So the first year it was like 10 million, the second year 50 million, the third year 100 million. And it was on a constant upward trail the whole time. But none of the profits were ever repatriated to Germany, which is a huge red flag. Instead, they were put into an escrow account in Singapore. Now, why would you put in money into an escrow account is beyond. Escrow accounts are normally used, I want to buy an asset from you. It's going to cost $10 million. I'll put it into an escrow account so you know that the 10 million's there and I can't touch it, but you're not getting your hands on the 10 million until I get the machine that you promised me. And that's what an escrow account is generally used for. Here, profits have been sunk into an escrow account. And every year, Ernst & Young diligently writes to the escrow account holder and says, how much money have you got there? And diligently, the escrow account holder replies, yeah, we've got 10 million, 50 million, 100 million, whatever the amount was that was on the books. And so they continued growing in this vein. One of the interesting parts is that Ernst & Young never appeared to send any of its auditors from around the world to these outlying ventures to make sure that they were actually earning the money. So Ernst & Young didn't visit Dubai, Singapore, or Malaysia, even with their local contacts in those countries. The regulators got wind of there being problems going back to 2013, and by whistleblowers who'd gone to BA-Fin and said, look, this is rubbish. These accounts are no good. And what then occurred is that they targeted the whistleblowers, threatening them with prosecution. instead of actually checking to see what had happened at the company. The fraud came to light when Wirecard tried to take over Deutsche Bank, and an independent audit was required. Deutsche Bank was, they insisted a separate audit was done, and KPMG did the audit and refused to sign off on it. Ernst & Young, we believe, had the audit signed and ready to go and said to Wirecard, fine, you transfer 300 million from the escrow account to Germany and we will let the financials go. Of course, Wirecard couldn't do that because none of the 1.7 billion in that account was real, and so that was the end of the game, and the fraud blew up with a 1.7 billion euro. Investors lost over 24 billion euro because of that fraud. So it goes to show how bad things are. So there's some key takeaways. Auditors don't necessarily find everything. There was no independent bank confirmations that were done. There was whistleblower suppression, both by the regulators and by the analysts. Everybody kind of ignored it. And there's been global repercussions about this. There's been a massive loss of investor confidence and a loss in the trust